China has officially said no to the United States. You did not read that wrong. Just 48 hours ago, Chinese officials, through the dual means of Ministry of Commerce, approval, and port enforcement, formally rejected U.S. silver export orders, totaling 50 million ounces. The justification was a single sentence. The intended use of the order was for COMEX futures delivery, which constitutes pure financial speculation and does not align with the industrial use required for export license approval. What does 50 million ounces mean? It is equivalent to 1.19 times the entire current registered warrant inventory of COMEX. In other words, this order was the ammunition Wall Street prepared to save its life, and it was directly neutralized by a single Chinese decree. This is not a trade friction. This is a resource war. This is not a technical rejection. This is a strategic interception. Even more intriguing is that before China made this decision, the COMEX Chicago Mercantile Exchange had already violently raised silver margins twice in 1 week, washing countless retail investors out of the market. The first hike was 18% on the 27th of December. The second was 22% on New Year's Eve, the 31st of December, and the third was 12% yesterday. The 3rd of January, the cumulative increase exceeds 50%, with the margin per contract soaring from $22,000 to $32,500. Think about that. The timeline is too eerie. First, use margins to drive out retail investors. Then China refuses to provide physical metal, and then institutions take advantage of the chaos to sweep up goods at low prices. After this series of combo punches, ordinary investors haven't even had time to react before losing everything and leaving the stage in tears. But what is the truth? The truth is that physical silver is extremely tight. The decline on the screen is merely a facade, a tool used by institutions to shake out the market. While you were being scared away, Wall Street giants like JP Morgan, Goldman Sachs, and Citi were frantically sweeping up silver from London and Zurich, paying premiums of $15 to $20 per ounce without hesitation. Why are retail investors always harvested? Why is there always a sharp drop before a major market move? Why suppress prices when supply is clearly tight? There is only one answer. They don't want you to know the truth. They don't want you to have a piece of the pie during the real big move. Today, I am going to tear away this veil and tell you exactly what is happening in the silver market and how you should respond. First, the conclusion, short-term, bearish news is about to be exhausted. Long-term, hard-hitting physical demand is the key. Retail investors leaving now will regret it so much they beat their chests in the future. Let me explain this clearly from the beginning. On the 29th of October, 2025, the Chinese Ministry of Commerce released a seemingly ordinary announcement, announcement number 69. It declared that starting the 1st of January 2026, silver exports would be subject to a single shipment, single review license management system, moving from a relatively loose quota system to a strict approval system, similar to that of rare earths. Many didn't pay attention at the time, as China's annual silver export volume isn't massive, and the announcement mentioned strengthening management rather than a ban. People thought it was a routine policy adjustment, but the real killer move was hidden in the details. The announcement clearly stipulated 3 core requirements. First, the qualification threshold was raised significantly. Only 44 enterprises nationwide obtained export qualifications, eliminating 90% of small and medium-sized traders. Furthermore, it required a continuous 3-year actual annual export capacity of over 80 tons and dual environmental certification. All 3 conditions were mandatory. Second, approval authority became highly concentrated. Every single export must be approved by the Ministry of Commerce on a per-transaction basis, canceling the previous automatic licensing system. This means the government can precisely control the flow of every ounce of silver. Third, and most critically, a strict ban on silver flowing into speculative financial markets. The General Administration of Customs issued implementation rules, stating that silver shipping orders destined for COMEX, approved delivery warehouses, will be 100% blocked. Do you understand? China made it very clear, silver is a strategic resource. It is for industrial use, and we will not let Wall Street use it for speculation. This policy officially took effect on the 1st of January, 2026, and just 2 days later, the first direct confrontation arrived. On the morning of the 2nd of January, 3 cargo ships loaded with silver at Shanghai Waigaoqiao Port were prepared to sail for the port of Long Beach, Los Angeles. The cargo totaled 28 million ounces. The owner was a trading company registered in Hong Kong, and the actual buyer was a U.S. precious metals clearing institution. Upon checking the export license, Customs found the final use field-listed COMEX futures delivery. According to the new regulations, this use is 100% prohibited. The ships were detained. That same afternoon, Tianjin port intercepted a batch of 15 million ounces of silver. On the 3rd of January, Shenzhen Yantian port intercepted another 7 million ounces. In 3 days, across 3 ports, a total of 50 million ounces of silver were denied export. Do you know what 50 million ounces means? Let me do the math for you. COMEX's total current registered warrant inventory is 42 million ounces, about 1,290 tons. This U.S. order is equivalent to 1.19 times the entire inventory. In other words, if this shipment had arrived smoothly, Colorado MEX inventories could have more than doubled, and the delivery crisis would have been resolved instantly. But now, that lifeline has been cut by China. Even more aggressive is the official stance. A Ministry of Commerce spokesperson responded at a regular press conference on the 3rd of January. We have noted the concerns of relevant parties regarding China's silver export policy. China's export control measures fully comply with WTO rules and are aimed at ensuring the security of domestic strategic resource supplies. We welcome global enterprises to purchase silver through formal channels for legitimate industrial use, but for orders intended for financial speculation, we will strictly review them according to the law. Translated into human language, this means if you want to buy silver for industry, we can talk. You want to buy silver to speculate on COMEX? No way. While these words are diplomatically phrased, the subtext is incredibly rich. It effectively tells the world that silver has been elevated to the level of a strategic resource equal to rare earths. Anyone wanting silver from here must play by the rules. Let us roll back the timeline a bit. What happened in the market? In late December, Colorado MEX silver futures prices rose rapidly from $68, at one point hitting $78, a nearly 15% gain. The driver was simple: physical shortage. News was already leaking that China might tighten exports after the new year, and smart money began hoarding physical metal, pushing up spot premiums. The futures market followed suit, with retail investors rushing in to go long. Sentiment was ecstatic. Financial forums and social media were filled with slogans like "Silver to $100" and "Physical is king." Many ordinary investors were eager to jump on this wealth train. However, just when retail enthusiasm was at its peak, the COMEX struck. On the 27th of December, the first margin hike, the COMEX announced an increase in initial silver futures margins from $18,700 to $22,000. An 18% hike. The official explanation was increased market volatility and the need to improve risk management. After this news, silver prices fell 4% that day. Many retail investors who were all in long received margin calls, and those with insufficient funds were forced to reduce or close their positions. But that was just the beginning. On the 31st of December, New Year, Eve, the second margin hike, the COMEX raised margins again from $22,000 to $26,800, a 22% hike. The timing was extremely insidious, occurring during the Western New Year holiday when liquidity was at its lowest. Silver futures gapped down at the Asian Open, at one point falling to $71. This gap trapped countless retail investors who had built positions before the holiday. Many woke up to find their accounts liquidated, with half their principal gone. After the market opened on the 2nd of January, it stabilized slightly, and some bottom fishing capital entered, bouncing the price to $74. But then came the bigger blow. On the 3rd of January, the third margin hike, the COMEX announced margins would rise from $26,800 to $32,500, a 21% hike. On the same day, news broke of the Chinese port blockades. With the dual bearish impact, silver futures dropped to a low of $68, 13% off the monthly high. With 3 hikes, the cumulative increase in 1 week exceeded 50%. Do you know what this means? It means with the same amount of capital, you can now only hold half the position you used to. It means if you were all in before, you must now close more than half your positions just to maintain margin. It means a massive number of retail investors were liquidated, lost everything, and left the market in tears. What is more disgusting is the choice of timing. The first hike was after Christmas before the New Year, the final days of the Western holiday when liquidity drops. The second was on New Year, Eve, during the quietest period for global markets, with no buyers to absorb the selling pressure. The third was right after the Chinese blockade news broke, stacking the bearish news to maximize panic. You tell me, is this a coincidence? Is this natural market volatility? Is this for risk management? Remember, this is a carefully planned massacre, and the target is the retail investor. Speaking of margins, I must tell you a detail most people miss. What is the margin requirement for COMEX gold futures? About $12,500, or roughly 13% of contract value, and silver, $32,500, which is roughly 33% of contract value. Both are precious metals, yet silver's margin ratio is 2.5 times that of gold. The CME's official explanation is that volatility assessment models show silver, as volatility is higher than gold, as requiring higher collateral for clearing safety. It sounds professional, but let me tell you the real reason. Silver needs such high margins not because it fluctuates, but because the physical supply is too tight. Think about it. If physical supply were ample and contracts could be delivered smoothly, why would the market fluctuate so much? Prices would stabilize at the supply-demand balance. But if physical is severely short and contracts face a risk of non-delivery, what happens? Longs will squeeze shorts, and shorts will scramble to buy. The CME knows the COMEX inventory situation better than anyone. They know 42 million ounces of inventory corresponds to 118,000 open interest contracts, a coverage ratio of only 7.1%. They know China has explicitly stated it will not supply COMEX. They know a delivery crisis is imminent. That is why they used such extreme measures, jacking margins up to 50%, to prevent speculative capital from entering and to save the physical for those who truly need to take delivery. Think about this logic. Skyrocketing margins are not a bearish sign. They are a twisted way of telling you that physical silver is at its absolute limit. Why doesn't T-gold need such margins? Because gold inventories are relatively ample. There is no looming delivery crisis. Gold's coverage ratio is over 35%, 5 times that of silver. This comparison is the best evidence. Let me explain the real situation of the COMEX silver market in the simplest terms. COMEX has two types of inventory, registered and eligible. Registered inventory has passed quality inspection and can be used directly for contract delivery, currently 42 million ounces. Eligible inventory is stored in COMEX, approved warehouses, but is not yet registered for delivery, about 150 million ounces. Many people ask, isn't T there still a lot of eligible inventory? Why is it tight? The key is that eligible inventory is not owned by the exchange. It belongs to various institutions and individuals. They store it at COMEX perhaps to wait for a better price as long-term reserves or for other uses. This silver does not automatically become registered for delivery. Only when the owner actively applies and is willing to sell at the current price does it convert. The problem is, in the current physical shortage, who is willing to sell their silver? Spot prices are already 30% higher than futures prices. If you are an owner, would you be stupid enough to sell at the futures price? Of course not. So eligible inventory just sits there. It won. T saved the market. Now, let's do the math. Current open interest is 118,000 contracts. Each contract is 5,000 ounces. That S590 million ounces of paper, silver registered inventory, is 42 million ounces. Coverage ratio equals 42 M sub 590 M equals 7.1%. What does this mean? It means 92.9% of contracts theoretically face a dead end with no silver to deliver. To use an analogy, it's like a bank with only $7 on the books, but $100 in checks issued. Normally it's fine because not everyone cashes at once. But once a run starts, the bank goes bust. The COMEX silver market is that bank. For decades, it relied on paper gains. Everyone believed contracts could be settled, so no one asked for the metal. One physical ounce supported 14 ounces of contracts. But now, that trust is collapsing. In late December, in just 4 trading days, 60% of registered inventory was requested for physical delivery, the most intense wave in history. At this rate, the remaining stock lasts only 1 to 2 weeks, and the 10th of January -12 peak delivery period is coming. I dare not imagine what will happen. If you only look at COMEX quotes, you see silver falling or oscillating between $72 and $75 looking bleak. But if you look at the physical market, you see a completely different picture. In the London spot market, physical silver is trading at $90 to $95 per ounce, a premium of over 30%. In Zurich, the premium is over 35%. In Shanghai, the RMB denominated price, when converted to USD, is about 25% higher than COMEX. This is the largest spot. Futures disconnect since the Hunt Brothers event in 1980. What does this price gap mean? It means if you hold a futures contract, you are forced to trade at $72, $75. But if you hold real physical silver, you can sell it in the spot market for $90, $90. That 30% gap is the scarcity premium. Why this split? Because the futures market is being artificially suppressed by margins. 50% margins keep speculative buyers out, weakening the long force, so the paper price is pushed down. But the physical market cannot lie. Industrial users and physical investors must bid based on real supply and demand. Demand exceeds supply, so the price skyrockets. Futures prices represent the result of a paper game. Physical prices represent the real world. When a massive gap appears, it means the paper game is severely distorted, and eventually, the physical will always defeat the paper. Either futures prices catch up to the physical, or the physical shortage worsens until the futures market collapses. There is no third option. You might ask, are institutions really buying the dip? What's the evidence? There is too much evidence. Air freight from London to New York has hit record highs. Normally, silver goes by sea, low cost, 3 to 4 weeks. Since late December, the Big Four, JPM, Goldman, Citi, Morgan Stanley, have been using air freight, regardless of cost, to move silver from London and Zurich to COMEX warehouses. Air freight is 10 times more expensive. Why spend the money? Because time is of the essence. They must have the metal before delivery day or face default, buying at $15, $10, $20 premiums. Some institutions are paying these massive premiums just to get physical metal. Think about it. Wall Street. Sharks are usually very calculated. If they are willing to pay 20% extra, it means they know the price will go even higher and physical will become even scarcer. They don't want to default. London silver lease rates have soared to 82% annualized. What is a lease rate? Simply put, it is the interest you pay to borrow silver for a time. Normally, it is less than 1%. Now, at 82%, to borrow 1 ounce for a year, you pay nearly 0.82 ounces in interest. This means no one is willing to lend their physical metal, not even for the short term. They know if they lend it, they might not get it back. Private agreements to accept gold instead of silver. To avoid default, some shorts are negotiating privately with longs. Since they cannot find silver, they are offering equivalent gold to settle. While this technically violates exchange rules, when you are fighting for survival, rules are broken. This shows the desperation of the Wall Street elite. The structure of warrant holders is shifting. Since December, JP Morgan's silver warrant holdings at COMEX have increased by 35%, the largest increase among all institutions. Citi is up 22%. Meanwhile, small and medium traders are seeing their holdings drop. Small holders are being lured by high premiums to sell to big banks. The chips are concentrating in the hands of a few giants. What does this mean? It means the future pricing power will be entirely in their hands. Now, let me tell you a chilling fact. The CME currently faces an unsolvable dilemma. 1. If the CME insists on physical delivery according to the rules, at the current consumption rate, 42 million ounces will be gone in 1 to 2 weeks. Massive numbers of shorts will fail to deliver and be forced into default. The consequences: first, massive penalties, 30 to 50% of contract value. Second, a total collapse of credit. If COMEX, the world's largest precious metals market, sees widespread default, its credibility is dead. Even worse is the chain reaction. A silver default would trigger a trust crisis in gold, copper, oil, and other commodities. If investors doubt contracts can be settled, the entire derivatives market shakes. 2. If the CME announces mandatory cash settlement, if they stop physical delivery and settle in cash at a set price, it's even worse. It is a public admission that COMEX silver is just a paper game, and they have no metal. Once that lid is lifted, Colorado MEX's pricing function is lost. Who would trust a contract that cannot deliver? The global silver market would fall into chaos. Furthermore, forced cash settlement would be a massive loss for longs, because the settlement would be at the suppressed paper price, e.g. $72, $70, $75, while physical is at $90, while physical is at $90, $17, $95. Longs would be robbed of 30% of their gains, leading to a tidal wave of lawsuits. Legal battles could drag on for years, no matter which path they take. It's a dead end for the CME. That is why they chose the third way. Back up margins to 50% to drive everyone out and buy time. This is a temporary fix to get some breathing room, but it's a treat the symptom, not the disease approach. The fundamental shortage remains. As long as China continues to block supply to COMEX and global industrial demand grows, inventories will continue to fall. The crisis is only delayed, not eliminated. We cannot talk about the silver crisis without mentioning the 1980 Hunt brothers event. Let me quickly recap that history because what is happening today is strikingly similar to 45 years ago. In 1979 FUVI 1980, the Hunt brothers of Texas tried to corner the global silver market. They bought silver futures and physical aggressively, at one point controlling 1/3 of the global supply. They drove the price from $6 in early 1979 to $50 in January 1980, a 700% gain. But the US government and the exchange wouldn't allow it. COMEX and CBOT launched emergency measures, massive margin hikes, position limits, and a liquidation-only rule, no new long positions. This caused the market to crash in March 1980, dropping from $50 to under $10. The Hunts were forced to liquidate and went bankrupt. See the resemblance. Skyrocketing margins, potential trading restrictions, and violent volatility. But today there is one key difference. Back then, it was the US government vs. two rich individuals. Today, the shorts are facing the strategic interception of the Chinese government. In 1980, the Hunts failed because they were just two men fighting the system. In 2026, will the COMEX shorts fail because they are facing the strategic will of a sovereign nation? That is why I say today, this crisis could be even more violent. 1980 was just a speculator being liquidated. Market order returned quickly. 2026 is a structural reshaping of the global supply chain, a direct confrontation between Eastern and Western financial hegemony. This impact could last for years or even decades. Let me connect the dots for you in a clear investment framework. Core judgment: silver is returning from being a financial speculative tool to its essence as a strategic industrial resource. For decades, silver was treated as a speculative toy, its price dominated by COMEX futures, where one physical ounce supported 300 paper contracts. It was a false prosperity built on leverage and credit. But now, the truth of physical shortage can no longer be hidden. China's export control is the fuse. The root cause is the explosion in industrial demand while supply cannot keep up. Photovoltaic, solar industry needs 2,000 plus tons of silver annually and is growing fast. AI chips need silver for conductivity. Computing demand is driving up usage. Electric vehicles. Each EV needs 25 to 50 grams of silver. Global penetration is rising. 5G infrastructure. Each base station needs 20-30 grams of silver. Medical devices. Silver's antibacterial properties are irreplaceable. Supply side, global silver production is about 800 million ounces and hasn't grown in a decade. Major mines are in Mexico and Peru. New capacity takes 5 to 7 years to develop. Demand is rising, supply is stagnant, and inventories are falling. This is the simplest supply, demand logic, and the most certain investment logic. Short-term price volatility is noise, a tool for institutions to wash the market. You shouldn't dance to the noise. You should see the trend and hold firm. The era of paper silver is ending, and the era of physical is king, is beginning. Finally, I want to share a few words from the heart. I know many friends were washed out in this move and feel terrible, with margins up 50%. Who can hold on? Being liquidated feels like being stabbed. Hard, earned money vanishing overnight. I completely understand that anger, helplessness, and frustration, but I want to tell you, do not be discouraged. Do not despair. The market is always volatile, and opportunities always exist. This time we were washed out because we didn't see through the institutional plot. They used margins as a weapon and information asymmetry as a shield to precisely harvest our wealth. Next time, we must be smarter. Remember this, when they want you to leave, that is exactly when you should hold firm. The long-term logic of silver hasn't changed. It has become clearer because of this crisis. The era of physical is king is here, and the trust crisis of paper silver is accelerating. At the start of 2026, we are witnessing a historic moment, a 100-year shift in the global silver market. Eastern and Western markets are splitting, pricing power is shifting, and the rules of the game are being rewritten. This is a crisis, but also an opportunity for those who see the trend and hold firm. This is a once-in-a-lifetime redistribution of wealth. I won't say I am definitely right, but I will say my analysis is based on facts and logic. I stand with the retail investors to expose the institutional plot, and I use the plainest language to tell you what is happening in the market.